Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Thursday. It's January 6th. It's 2022. Don't ask me where 2021 has gone. Market's going to open up in about an hour and 22 minutes to be exact. And as you can see here, the Dow's doing really, really good, actually. It's up 87. I mean, not really, really good, especially in light of what happened yesterday. But it's doing a lot better than the Nasdaq, which is down 87. Yesterday, the Nasdaq really pulled down the Dow, which actually made all-time highs. Now, based on what I'm seeing right now, and based on yesterday, by the way, yesterday was 28 years that I got into the markets. 28 years. So today in my daily video, my second video, I'm going to talk about all the things that I would teach myself if I had to start over again. I'm going to play the Back to the Future game, and it'll be fun. Don't miss that video out. But again, today is 28 years that I've been involved in the markets. I'm getting pretty old. But anyhow, getting back to the analysis, I'm looking for a shakeout in the Nasdaq. Matter of fact, and I'll get into all the details in a minute, but I think I think this is a little bit too much of an overreaction. If you look at the bonds, they kept going lower. They're not really going higher in a defensive fashion. And in my opinion, bonds are overdone to the downside right here. They're literally at our support level, and I think they're ready to go higher from these levels right here. So I think we're going to see a little bit of a rally in the bond market since we're grossly oversold right now. Also, if you look at this at the QQQ, these range bars right here, they're typically when you have a range like this, when there's very little volatility and it's consistent, you see continuation of a trend. But when you see bars like this, it usually means that it's panic, or it's the end of something, or it's forced, or there's a big disagreement between buyers and sellers. Typically, this happens during cool-out days, and it was a lot more prevalent in some of the large cap stocks, like, for example, Fortinet. Let me just give you some ideas so you can see what I'm talking about. Look at that. Big. Typically, when you see these big waterfall sell-offs, they don't tend to last too long. They're usually reactory. Also, when you look at the put-to-call ratio, put-to-call ratio is finally above 1. That's telling us that the market is getting overly bearish right now. That's a big sign that the market is getting a little too bearish right now, that it's going to go a little higher. So I'm thinking that we may be seeing a shakeout because of the put-to-call ratio. It's above that 1 level that we look at. Then, if you look at volatility, you will see that volatility is not really reacting all that crazy to this. I mean, we've had 2 big days of shakeouts. The Dow lost hundreds of points. This isn't a big volatility move. So the market's not really reacting like this is it. And if you look at the momentum levels, the S&P, number of stocks trading above the 50-day moving average, we're at 65%. We usually peak out around 90, 84. We're just at 66 percentile. So there's really nothing crazy here. Momentum levels are looking healthy. This is a 10-year chart. We don't usually peak out around these levels. As you can see here, we've gone higher many times, and this is a monthly. If you look at it on a 9-month basis, we've gone, or like a year basis, we've gone a lot higher several times. So again, I don't think momentum levels are all that crazy right now at 65. I honestly don't. So I'm not really seeing anything too big. Let's talk about economic data. Today we've got international trades in goods and services. That's coming out in about 20 minutes. By the way, yesterday's data, the ADP data, this is a private report reflecting on the employment situations. We had twice as many people getting jobs, so the economy is really getting stronger. It's the FOMC minutes that screwed us up yesterday, big time. So, but for the FOMC minutes, which is just them projecting that they're going to move the timeline, which we kind of knew already, things aren't looking all that bad. So today, keep your eye on international trades in goods and services. This will fill us in on the bottleneck and the supply chain issues around the globe. Jobless claims, not really expecting anything major. Factory orders, this is going to be important. ISM Services Index, this is going to be important. And then we're going to cap the week off tomorrow with the employment data. As far as the S&P 500, we're hitting the 50-day moving average. Typically what happens is we cool off, we shake out, we go right below the 50-day line, and then we come up I'm not really seeing any major meltdown signals. I'm not seeing anything really all that crazy. I mean, it's a good thing to be a little defensive, but honestly, if you look at the Dow Jones, you will see that we're literally coming off all-time highs. So I wouldn't make too much out of what's happening right now. I mean, it looks to me, it looks worse than it really is, and especially looking at market internals. Global market economy, let me just give you the full picture. Global stocks, Wall Street futures tumbled Thursday. That's over in Europe and Asia overnight after investors saw minutes from a Federal Reserve meeting as a sign that U.S. central banks might hike interest rates faster to cool inflation. We've been talking about that nonstop. Benchmark in London, Frankfurt opened down more than 1%, while Tokyo lost 3% following what we saw in U.S. Notes from the Fed meeting last month showed policymakers believe the U.S. job market is nearly healthy enough that ultra-low rates are no longer needed. Traders took that sign as the Fed might be more aggressive about rolling back stimulus that is boosting stock prices. Not so sure they're going to be doing that fast. The Fed minutes showed policymakers express concern that inflation was spreading into more areas of the economy and would last longer than expected. Gee, you think, Powell? You think? It's transitory, right? It's transitory. They discussed the possible need to raise short-term interest rates at a quicker pace and allowed bond purchases that inject money into the financial system decline sooner. And I think even if that's going to happen, it's still going to keep the market very strong. 4 out of 5 stocks, basically 4 out of 5 stocks lost yesterday. Tech stocks got hit hard. Microsoft, ouch, got hit 3.8%. Adobe got hit 7%. Adobe was downgraded by UBS. But the bottom line is, I still see the market as fairly healthy. If you look at the stock fetcher, if you look at our sectors, consumer staples is leading, but look at technology and consumer discretionary. This looks very different on a 1-month basis, very defensive. I mean, all through and through. So I think the market's getting more defensive. I think it's repositioning itself, but at the same time, I feel like this downside, I don't think it's going to last very long. Matter of fact, I think the trend is stable. I think we're going to bottom out either today or tomorrow on the Nasdaq, and I think we're going to go higher. So let's see how the next few days goes. Let's not over panic. And to me, this looks like a healthy correction. My concern is whether the Nasdaq is going to make all-time highs or congest around this area after the pullback. But the put-to-call ratio right now is definitely, clearly, 100% telling us that that this market is oversold right now, right there. Now, we could go a little higher, but I think the worst is almost behind us based on these signals and based on the put-to-call ratio. I think buyers are going to be stepping into the markets. I think New Year's is here. I think hedge funds, large hedge funds, are just coming into the market end of this week. So don't make a long-term picture out of what's happening right now. This is still beginning of the week. Markets are getting adjusted. There's a lot of fragmentation around. Let's be patient. Let's hold on. Let's see the result of this. And again, with the volatility like this, they don't usually last very long, especially with the put-to-call ratio jumping above 1. Now, before I let you go, I've got something very important and very timely for you. Oh, by the way, I forgot. I was supposed to give you an ETF pick today. So my ETF pick right now, I'm gonna be very, very honest with you. My ETF pick right now is the Dow Jones. I like the Dow Jones Industrial. I like the fact that we made all-time highs. I like DIA right now. And let me give you the option for this. Almost forgot. Let's go to, there we go, March. I would go to March, and I would go to right around the 370-ish level. Yeah, the 370-ish level looks really good. It's not expensive. This is a really, really good option. And if you're going to do a spread, go ahead and buy the 370 and sell the 390. That's what I would do. I wouldn't go further. It'll offset some of your cost. 370, 390, or just buy the 370. But I believe the Dow is actually going to go higher. And I think the fact that it made all-time highs yesterday and pulled down off of the Fed is just telling us and giving us a good indication of exactly how strong the Dow is. So these little pullbacks, these shakeouts, they will happen. But I'm going to tell you right now, The Fed is very vested in the stock market, and I think they're going to do everything possible to keep it up, even pressing back on their plans to cool off the bond buying if they have to, if they see that the market's in a mess. They still have some control over the bond buying. So don't get too bearish on me just yet. Now, I got to tell you guys something interesting, something important. Every single month, the big hitters on Wall Street, they tip off what stocks they're going to pile into. They do. And Joy of the Trade, head trader Jeff Zananeri, he's about to show us, once we've placed our trades early in the month, the hard part is done because Wall Street takes over and does the heavy lifting for us, buying up shares and pushing prices higher. Now, this exact strategy pulled a fat, juicy, whopping 210% winner from the market in January of 2021. Folks, click the link below. See how traders can add this powerful trading strategy to their trading toolkit in January. Volatility is here. This is the time to profit. Follow the link below. Jeff is no slouch. This guy managed institutional money for years. 210% in January of 2021. We're in January 2022, and he wants to bring you on to these opportunities. Follow the link below and learn how this powerful strategy can change your January. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. I want you guys to stay ahead of this market, this crazy market, and you can do that by being notified when I post my next video. And tomorrow, oh boy, we're going weekly recap, biggest winners, biggest losers, what to expect next week. I put the link to Jeff's presentation below. Follow it, learn all you can, and take notes. And don't get too bent out of shape with this market. I think we're going to come back. I'll talk to you guys soon. Bye.